My next guest is the head of interest rate strategy at Credit Suisse. And the title of his latest report is Take a Hike. Carl Lantz is with us this morning. Carl, great to have you with us. And, you know, with this, what Bernanke said last night is really a culmination of similar comments he's made over the last few days about the economy, saying, look, it's too early to celebrate an economic or jobs recovery. What do you read into that?
Yeah, well, I think he's speaking to markets. Markets were getting a little bit too excited. As we noted in that piece, if you look at market pricing, the market was suggesting the most likely time for the Fed to start hiking was actually in the middle of next year. You know, something like a 24% chance they go next year. Obviously, that distribution is quite spread out, but most likely it would be next year. That was reflected in higher rates across the curve. And I think Bernanke sort of purposefully tried to reel back those expectations because realistically, job growth has been pretty good, but we've got a lot of jobs to make up from what we've lost from 2008. Right.
So in a sense, he was trying to talk yields down then.
Yes, I believe so.
Okay. So when do you see a rate hike scenario?
I take him at his word, more or less. I mean, I think it'll be 2014. It could be earlier in the year than he suggests. Obviously, he might not even be chairman come January 2014.
Right.
But we've got a long way to go. When the real thing here, the distinction that people need to make is the difference between the level of activity and the rate of change. So, okay, we're making 200,000 jobs a month, but we've got 5.6 million to go before we get back the jobs we've lost. GDP is growing 2 or 3%, but we've got something we're somewhat like 8% below trend. Mm-hmm. The sort of center-left coalition at the Fed, including Bernanke, don't see a problem with inflation until we close that gap. And I think we need to close it faster rather than sooner, because the longer these people are unemployed, the harder it is to employ them in the long run. So there's long-run damage to the economy if we can't get going even faster. So they would welcome 200,000 payrolls, they would welcome 400,000 payrolls, and I don't think it would materially change their policy.
Well, in that backdrop, Bernanke, you heard him last night and before, say that QE3 is not off the table. And, you know, we know that from having read, you know, the minutes of these Fed meetings in the last several months. But, you know, do you take Bernanke at his word there, or do you think that he's really just talking about it in order to, again, bring those yields down?
No, I think he was actually fairly restrained there. I mean, I think Bernanke intends to launch another QE program. I think he wants to retain some optionality and not commit to anything at this point. But, you know, the Fed is still providing support to the bond market. I think it is having some effect, and it's helping raise asset prices and probably having some effect on the real economy. And I don't think the Fed wants to risk pulling that away suddenly at the end of June. You know,
right.
If it ain't broke, don't fix it.
You know, it's funny, Carl, that you talk about what the Fed has done in the support because, and, you know, from Operation Twist and other programs, because there's a journal piece this morning from Lawrence Goodman who talks about how the Fed in the last year, right, I don't know if you read this piece, but in 2011, the Fed was responsible for 61% of the purchases of Treasury issuance last year, which I think is a huge rise, 45%, I think, above from a few years ago. So given all of this Treasury buying, Treasury buying by the Fed, you almost wonder how much they're distorting the Treasury markets, right?
Certainly, there has to be an impact. I think it's very easy to overstate it. At the end of the day, it's hard for yields to deviate too much from what the market expects the path of short rates to be. So to the extent they're buying Treasuries, they also have to be given a consistent message about their intention to hold short rates down. And that's exactly what they're doing. So the policies go hand in hand. It's very hard to measure the impact. Even the Fed doesn't know the impact. But we suspect there is some material 25, 30, 50 basis point impact. And at this stage in the recovery, I'm not sure why it's worth risking pulling away from that sort of program. We don't see much evidence of inflation, underlying inflation in the economy at all.
But does it concern you that they are buying so many treasuries at a time when foreign governments like China are scaling back on their treasury buying?
Well, in a way, that's going to happen naturally. If it wasn't the Fed, I think there'd have to be domestic buyers stepping in. We've cut our current account deficit basically in half in the last several years. So our net borrowing needs from abroad are actually much lower. And that's not driven by the federal government borrowing less, but the private sector is deleveraging and borrowing far less. So on net, we don't need to borrow as much from abroad. So whether it be the Fed or it be, mutual funds or domestic buyers, by sheer mathematics, domestic buying has to pick up here.
Okay. All right, Carl, thank you. Great to talk with you. Carl Lantz of Credit Suisse.